welcome to the CNBC-TV18 Mumbai studio. I'm Ekta Batra and you're watching Your Stocks this afternoon. Well, it's turning out to be a stellar session for the markets. We have the Bank Nifty, which is up around 2% We have the Nifty, which is up around 342 points. The Bank Nifty has surpassed 47,000 on an intraday basis and the Nifty is sitting at a record high. So good going for the markets. We have a very strong advance decline ratio on our hands as well, which currently stands at around 2:1. Joining us this afternoon, we have Shahina Mukadam, who's the independent market expert, and Kush Bohra, founder at kushbohra.com, to answer all of your queries this afternoon. Shahina as well as Kush, welcome to the show. Well, Kush, I'll start with you. It's a stellar day for the markets. How would you position yourself in the last 1.5 hours of trade?
Hi, first, a very good afternoon. I would probably take some money home, to be honest. I mean, we perhaps expected some kind of a bounce after, taking support at the 20-day moving average yesterday and, holding somewhere close to the 22,000 mark. But I think this is not something that anyone expected, the day to end like. So, and also we're approaching the target of 22,500. So the risk reward ratio from here on will not be as favorable. So if you've got positions, my suggestion would be to take some money home and hold the rest with a trailing stop loss and ride for the targets of 22,500 at least on the Nifty.
Okay, all right. Well, let's get in some queries now. The first question is Gopinath Rao. He writes to us from New Delhi. He holds 6 shares of IGL, which he's bought at around 543 odd rupees. So he's sitting on a loss. He says he's been holding the stock for 2 years. He's asking whether to remain invested or to exit at current levels. So my loss is what he's sitting on at this point in time. What would you recommend, Shahina? 6 shares of IGL, which is bought at around 543.
I would advise that he cuts his position and exits, because as we saw, the third quarter numbers also pretty disappointing. Largely on increased costs, EBITDA was lower, and the costs have been higher for average gas prices for them. So it's better to exit.
Okay, you'd recommend exiting. Kush, what about the technicals?
Fairly similar view. The stocks actually not done too much in the last couple of months. In fact, and every rise has been taken as an opportunity to sell. The 200-day moving average is proving to be a stiff resistance. So agree with Shahina here. Exit is perhaps a good choice, for IGL.
Okay, all right. Well, let's get in another question now. We have Sujit Kumar, who writes to us from New Delhi. He holds 3,000 shares of PVR, which is bought at 1550. So he wants to know what to do. He's sitting on a loss at this point in time, whether he should book his losses or remain invested. Well, Kush, I'll start with the technicals on this one. What do you recommend? Do you think that there's upside potential to get to at least the buy levels of 1550?
Well, in the near future, it looks a little unlikely, because for the last 10-15 odd sessions, the stock's been under severe pressure with no buying emerging, not even a dead cat bounce. The only saving grace that could come in is that the stock is close to the support zone of 1350 and is approaching oversold territories. Hence, we could see that dead cat bounce that I spoke about. My suggestion would be to hold with a trailing stop loss of 1350 and use any kind of rise to exit out of this. 1550, the buying price seems a little distant now. May not be seen for at least a couple of months. So if he can hold with a trailing stop loss and keep exiting at every rise.
Okay, keep exiting at every rise. Well, Shahina, what would you recommend on PVR in terms of the fundamentals? Do you think that there is a possibility that towards the year end there could be maybe some amount of upside on the fundamentals?
Not really. Actually, I've never been, I've never been very positive on PVR as a stock, and basically the reason being that they have had very, it's not been a very happy type of performance in terms of fundamentals. While of course third quarter was a bit better because we had some large movies, good large production movies that came out and did well. But I think if you really want to be in the entertainment space, there are other opportunities. It's better to be in direct content providers, something like even a TV18 or maybe hotels. But I'm not too positive on PVR, both for the shorter, medium or longer term. There could be bounces depending on their numbers and how they move. But I think there are other opportunities, better ones that are there.
Okay, all right. Fair enough. So better opportunities. Any kind of alternative that you would recommend in terms of a stock?
See, as I was mentioning, I would prefer something like a direct content provider, like say a TV18. I would even provide what I would also like hotels, like maybe even Indian hotels, though they are pretty expensive at current levels. But if you look at the medium to long term, I believe the prospects are better. So I'm talking from a very long term basis, not from a short term. I think the opportunity to be in the entertainment segment is should be not PVR but some other sectors.
Okay, all right. Let's get in another question now. We have Vaibhav Prabhudesai, who writes to us from Chennai. He's holding 1100 shares of IDFC First Bank, which he's bought at around 86 odd rupees. He's a long-term investor and wants to know what to do, whether he should hold these shares for another 4 to 5 years. He's asking whether to remain invested or to exit from this particular counter. So that's on IDFC First Bank, sitting on a loss on this one. Marginal, but do you expect a recovery, say, on the technicals? Kush?
It doesn't look as bad on the charts. It's consolidating after a nice run up. My only concern is that, the alternatives are starting to look better now. And, I think he's mentioned something about HDFC Bank as well, in his comments. But from here on, the risk reward ratio looks extremely favorable for something like an HDFC Bank, or if he's willing, then something like a PNB. Both of them provide an alternative to IDFC First Bank. My suggestion would be, if he's okay to start shifting at least the part of his holdings from this one to HDFC Bank, or perhaps even a PNB, depending on his preference. So that would be my suggestion. Independently, IDFC First Bank also doesn't really look as bad, but as I said, the alternatives are now starting to appear a little more.
Okay. And Shahina, what about you?
Well, see, if you're talking of a long term, then one can continue to hold. You're talking of a 3 to 5 year period. Definitely, things should look better. They are already looking better. If you see the last quarter numbers, you'll see the last couple of quarters. Balance sheet is improving, ratios are improving, and the growth is pretty strong across all parameters. You have their deposit growth, loan growth, everything is looking good. But the issue for the shorter to medium term is the valuations. Now the stock has run up, and the valuations at 2 times plus, I think it's around two times book, which makes the in terms of valuation is pretty close to some of the larger private sector banks. So I would say that shorter to medium term, it will consolidate at best at current levels. I would think it will move between the 70 to 90 band for quite some time. So I would agree with Kush. For the shorter term, yeah, you can sort of switch. But if you're a long-term holder, you can just hold and wait.
Okay, all right. That point is taken. That's on IDFC First Bank. Well, we have another query now. Samik Mohapatra writes to us from Mumbai. He holds 3,000 shares of Indus Towers, which he's bought at around 250. He wants to know what to do, whether he should sell or hold. Well, Indus Towers has done well. He's sitting on a profit right now. The stock has given returns of around 30% on a year-to-date basis. And has been in focus on account of, the fundraising with regards to Bohra idea. Fundamentally, Shahina, how would you approach Indus?
Ekta, I totally agree with you. Actually, the turnaround for this stock, at least in my view, which makes it a hold, is basically the fundraise that Vodafone has done. So, to that extent, hopefully the write-offs provision should be lower and the profitability should be better. And there are also talks of a new entrant coming in. So all these things make it look to continue holding the stock for the medium to longer term. So I would say you continue hold at current levels.
Okay, and Kush, what about you?
So for sure, hold the kind of breakout that we saw in the last couple of days is something that, I think a lot of traders were waiting for on this one. Even if you see positionally, 250, 255 was a strong resistance zone levels that the stock was at, way back in Jan of 2022. So, medium to long term kind of levels are being taken out, which often suggests, higher levels to come. So here too, the suggestion would be to hold with a trailing stop loss of the buying price, which is close to 250. 275 would be the immediate level to look for once that is taken out about 295. But that's when I would, start taking some money off, perhaps partly at 275 and then the rest at, about 295 levels.
Okay, all right. So that's on Industars. Well, we need to take a short break on that note, but we have a lot more queries. It's a very lively market, so stay tuned. We'll be back soon. Welcome back. Well, we still have with us Shahina Mukadam as well as Kush to answer all of your stock queries this afternoon. Let's get in another question now. We have Pankaj, who writes to us from Hyderabad. He holds 250 shares of ONGC, which he's bought at around 250 odd rupees. So he's sitting on a profit there. He wants to know the future prospects of his particular investment. Well, going into elections, what would your recommendation be, Shahina, ONGC?
Well, the investor can hold it, keep a stop loss closer to the buy price. So that can allow him to participate in the upside. Even the Q3 numbers were not that encouraging. So basically the stock has been consolidating after doing pretty well for some time. And I think it's again on the up move because, it accounts for more than, I think, 60% of our crude oil production that we need, whatever's produced in India, what is required. You have more than 50% of the gas supplied by them. So I think, one can continue holding ONGC for the longer term.
Okay, all right. And Kush, what about you? What would you recommend on frontline stocks such as ONGC? Considering the kind of momentum that we've already seen on it, it's given returns of over 30% this year.
In fact, those are the ones that you should continue holding in your portfolio, and the same advice goes for ONGC also particularly. Similar advice: place a trailing stop loss of the buying price. The recent high of about 275 to 80 should be the first target. I would look to book partially here and hold the rest for the levels of 295 to 300. So hold with your buying price as a trailing stop loss, and book partially around 280 and 300.
Okay, all right. So book around 280 to 300. All right, let's get in another query now. We have Lakshman, who writes to us from Mumbai. He holds 600 shares of Techno Electric, which he's bought at around 820 odd rupees. So he's sitting on a loss on that one. He wants to know what to do, whether he should book his losses or whether he should exit. Well, what would you recommend, Shahina, on Techno Electric on the fundamentals?
See, the investor has bought it at the recent high. So that is why he's running into a loss. I would say that he can continue to hold, but keep a stop loss somewhere maybe closer to 700. The company has good orders. They are into renewable energy. They've got capacity for wind power. Also, in terms of new areas of business, they're getting into electric meters, data center. I think these are positives. A lot of institutional investors are invested in the stock. So this is one stock that the investor will have to continuously monitor. If there is selling or if there is excess liquidity in the stock or distribution, then he can get out.
Okay, all right. And what, Kush, any view on Techno Electric on the technicals?
Well, the setup's not really as encouraging for the last 2 to about 3 months or so. The stock's not really gone anywhere. I think if he does want to continue holding, then 680 would be a stop loss that I would place. No averaging, no fresh entry. That's something that I would suggest. But if he wants to continue holding, then 680 should be a fixed stop loss.
Okay, all right. So there should be a strict stop loss if you want to continue holding. That's the word coming in on Techno Electric. Well, let's get another query. We have Sohail, who writes to us from Meerut. He holds 200 shares of Mangalore Refinery and Petrochemicals, which is MRPL. He's bought it at 160 odd rupees, so he's sitting on a good profit on that one. Wants to know what to do, whether he should continue to hold or to book his profits. And, it's been a stellar rally for MRPL all the way from its 52-week low of almost around 50 odd rupees. Look at where it's sitting at today, Shahina. What would your recommendation be?
I would say at least book part profits that the investors should do because the numbers have been a bit disappointing. GRMs, if you saw last quarter, was just $5, and valuations, in my view, are a bit on the higher side for MRPL compared to its historical valuations at current levels. So I would book part profits.
Okay, you would book part profits. And Kush, what about you?
And I'd suggest hold this with a trailing stop loss of 210. What we are seeing in the last 8-10 odd sessions where the stock dropped from 280, 290 kind of levels to 230 is commensurate with the kind of rise that the stock had seen, right? I mean, 3-4 sessions it had moved from 180 to about these 280 levels. So it's just a froth coming off. Interestingly, it's also taking support at the 20-day moving average. So if it does hold up at these levels and rebound, then the stock's in for higher levels of 255 and then perhaps those high levels of 280 again. So my suggestion would be you could continue holding, just place a trailing stop loss at 210. I mean, if stock was to fall at that level also, he'd exit on a handsome profit.
Okay, all right. Let's get in another question now. We have Samir Shah, who writes to us from Agra. He holds 10 shares of Shriram Finance, which he's bought at around 800 odd rupees. So he wants to know what to do, whether he should buy more or not. So he's sitting on a profit on this one. Obviously, it's been in the news. Kush, what would your recommendation be on this?
The first one would be to enjoy a happy weekend with all the profits, at least notionally. But other than that, this stock is a buy on dips. The run's been quite stellar, and as you said, the news just come out, so the stock might consolidate here. So any kind of dip that you get towards, let's say, 2400, 2375 kind of odd levels can be utilized to maybe buy some more. We think that the stock has more room in the coming days. 2650, 2800 also is a level that the stock can touch. So no harm adding some more.
Okay, so that's on Shriram Finance, the new nifty entrant, which will be replacing UPL. Just want to point out that Dr. Reddy's is in focus on account of a particular lawsuit in the US. That stock is weighed down by around 0.6%. We'll get to that news in just a bit. But fundamentally, Shahina, what would you recommend on Shriram Finance?
I would agree with Kush. One can continue to hold and maybe buy at dips. If you saw the last quarter numbers, the credit cost was a bit higher. But I think the management has indicated that going forward, that would be, that would not be the case. And also in terms of their overall growth, they are doing pretty well. So I think the consolidated entity looks good for the medium to longer term. So one can continue to hold.
Okay, all right. Well, one can continue to hold. That's the view on Shriram Finance. KS Rao writes to us from Andhra Pradesh, holds 200 shares of Rain Industries at 70 odd rupees. He's a long-term investor, wants to know what to do with his current investment, which he's sitting on a profit on. Kush, over to you on this.
Well, book partially at current levels, book out at least 50% on the current levels. The stock's actually been not just a bit, actually, it's been quite volatile and might see some downside. So not a bad idea to book some profits here. So the idea would be to book 50% at least at these levels. Hold the rest, if this fall was absorbed, then it could perhaps retrace to those, 200 and 220 levels again. So book 50%, hold the rest for 220 kind of levels.
Okay, all right. Well, the lawsuit which Dr. Reddy's has been named as a defendant in is basically to do with Revlimid generic. So it basically indicates that, the claim is that under federal antitrust law, alleging that Dr. Reddy's is acting in connection with Celgene, BMS, Natco and Teva in the sale of the brand and generic Revlimid through their respective settlements of patent litigation and improper generic competition through 2026. So the complaint seeks for damages with regards to Revlimid generic. Remember, it's been a big revenue generator for the industry, and there have been indications of these kind of complaints coming through, which generally happens when such huge settlements happen. And let's see how things progress. Generally, it leads to a settlement or maybe it's taken to court. But nonetheless, the stock is down around 1.5%. It's to do with Revlimid generic, something I think that the street already had a whiff about. But nonetheless, that's all the time that we have on the show. Shahina as well as Kush, thanks very much for joining in. Do remember to email us your queries and we'll address them with our experts. Stay tuned, closing the up next.